Welcome to Module 4, where we'll be focusing on fixed interest rate mortgage loans. This module will help you understand how these loans work, their key features, and why they might be a good choice for certain borrowers. Let's dive in and explore the fundamentals of fixed rate mortgages. A fixed rate mortgage is a type of home loan where the interest rate remains the same throughout the entire term of the loan. This means that your monthly payments, which cover both principal and interest, stay consistent from the very first month all the way to the end. One of the biggest advantages is that you won't experience any payment shocks due to fluctuations in the market, since the rate never resets. This predictability makes it much easier to plan and budget for the long term. Fixed rate mortgages are best suited for those seeking stability. They typically come in terms of 15 or 30 years, which are the most common options available. Let's break down how fixed rate loans work, starting with the origination process. First, you apply for the loan, verify your income, and then choose a loan term, which is typically either 15 or 30 years. This step sets the foundation for your loan agreement. Next comes the rate lock. At this stage, the lender locks in your interest rate before closing. What's important here is that once your rate is locked, it won't change before closing, giving you certainty and peace of mind about your loan costs. Finally, after closing, you begin repayment. The principal and interest payments remain the same throughout the entire loan term, making your monthly payments predictable. Over time, as you pay down the loan balance, more of your payment goes toward reducing the principal rather than interest. This fixed interest rate ensures stability and helps you budget effectively without worrying about fluctuations during the life of the loan. Let's talk about what an interest rate lock is. Essentially, it's a commitment from your lender to keep your agreed-upon interest rate steady for a specific period while your mortgage application is being processed. This means that no matter how market rates might fluctuate during this time, your rate won't increase unexpectedly. This protection is really important because it gives you peace of mind, knowing that your mortgage costs won't suddenly go up before you close on the home. So, the interest rate lock acts as a valuable safeguard against rising rates during the loan process. Let's talk about the key advantages of fixed rate loans. First, predictable payments are a major benefit. With a fixed rate, your principal and interest stay the same throughout the entire life of your loan, so you know exactly what to expect each month. This consistency makes budgeting much easier because your monthly costs won't suddenly spike. Another important advantage is rate protection. When you lock in a fixed rate, you're protected from future increases in the market. Even if interest rates rise, your mortgage rate stays the same, which can save you money over time. Finally, fixed rate loans provide peace of mind. They are straightforward and simple to understand, minimizing surprises. This stability makes long-term financial planning much more manageable and less stressful. Overall, fixed rates offer security and predictability, which many borrowers find invaluable. Let's talk about payment stability and why it's so important when it comes to budgeting. Having predictable payments means households can plan their cash flow with confidence, which makes managing finances much less stressful. When you know exactly how much you'll pay each month, budgeting becomes simpler because there are no surprises. Another key benefit is protection from rising interest rates. With a fixed monthly mortgage payment, even if market rates go up, your payment stays the same. This kind of certainty allows you to focus on your long-term financial goals without worrying about sudden increases in housing costs. For example, a typical fixed-rate mortgage might have a consistent monthly payment of $1,842 throughout the entire 30-year term. Whether it's year 1, year 5, year 15, or year 30, the payment remains steady. This consistency in principal and interest payments makes planning for the future much easier and gives peace of mind for the long haul. Let's talk about the differences between fixed rate and adjustable rate mortgages. With a fixed rate mortgage, your payment remains the same for the entire loan term. Both the principal and interest stay steady, which means you have predictable monthly payments. These loans usually come with higher initial rates at closing, but the benefit is you never have to worry about the rate resetting. This offers lower long-term uncertainty and more financial stability. On the other hand, adjustable rate mortgages start with a lower initial rate after a fixed introductory period, so your payments may be more affordable up front. However, the rates adjust on a predetermined schedule based on an index plus a margin, which means your payments can change over time. This introduces more exposure to rising rates and potential increases in your monthly payment. Understanding the risk profile of each type is crucial when deciding which mortgage works best for your financial situation. Let's talk about understanding amortization and how your loan payments are structured over time. At the beginning of your loan term, like in year one, most of your payment is applied toward interest rather than the principal balance. As you continue making payments each year, by year 5, 10, and beyond, you'll notice that more of your payment gradually goes toward reducing the principal. This shift happens because the interest portion decreases as the outstanding loan balance gets smaller. What's important to know is that even though the amount of interest and principal changes with each payment, your overall payment amount can remain consistent throughout the entire loan term. This steady payment, combined with the shifting mix of interest and principal, is the essence of amortization. It ensures that by the end of the term, whether it's 15, 20, 25, or 30 years, you've fully paid off your loan. Here, we're looking at the current market context concerning interest rate trends and lender rates. As you can see, rates have moved significantly since the pandemic lows, with some key fluctuations over the years. Notably, in 2021, we hit a trough at 2.9%, which was a rare low point. Since then, rates peaked in 2023 at 7.1%, reflecting a sharp increase in borrowing costs. Looking ahead to 2025, rates are expected to moderate to around 6.4%. These shifts are crucial because even small differences in lender pricing, points, and fees can have a substantial impact on the total cost of borrowing. Understanding these trends helps us anticipate market movements and make more informed financial decisions. Now, let's walk through the loan origination process step by step. Each of these stages is crucial because they move the loan closer and closer to funding. We start with pre-approval, where the lender assesses a borrower's initial financial information to determine their eligibility and loan amount. Next is the application phase, where the borrower submits all the necessary documentation in detail. After that, we move into underwriting, where the lender evaluates the financial risk and verifies all the information provided. Then, the appraisal step comes into play, where the property's value is assessed to ensure it supports the loan amount. Finally, we reach closing, the last step where all paperwork is signed and the loan is officially funded. Understanding these stages helps clarify the path your loan takes from start to finish. Let's talk about the factors that influence loan approval, especially focusing on credit scores and overall file strength. Credit scores typically range from 300 to 850, with scores above 620 often opening the door to conventional loan approval. However, the quality of your credit score matters. Scores can be rated from poor to excellent, and lenders pay close attention to this. One of the most critical elements is payment history. Late payments and collections can quickly weaken your application, so maintaining a clean payment record is essential. Another important factor is your debt-to-income ratio, where lenders compare your total monthly debt payments against your gross monthly income. A manageable debt load leaves room in your budget for new housing payments, which lenders see as a positive. Stable income and assets also play a big role, as consistent employment and adequate cash reserves improve lender confidence. Furthermore, the loan-to-value ratio, which relates to how much down payment you can make, can help offset moderate credit weaknesses. A larger down payment reduces the lender's risk. Strong loan files typically combine a higher credit score, manageable debt, verified income, and cash available for closing costs. These elements together lead to better pricing and fewer concerns during underwriting, simplifying the approval process overall. Understanding these factors helps you prepare a strong application and improve your chances for loan approval. Let's take a closer look at how your down payment affects the terms of a mortgage, using the example of a $400,000 home with a 30-year fixed mortgage. Starting with 5% down payment, which is $20,000 up front, you end up borrowing $380,000. This comes with a higher interest rate of 6.9% plus private mortgage insurance, or PMI, so your estimated monthly principal and interest payment is about $2,503. This option has the highest monthly payment and the added cost of PMI. Now, If you put down 10% or $40,000, your loan amount decreases to $360,000. Your interest rate drops slightly to 6.7%, but PMI usually still applies. Your estimated monthly payment goes down to $2,322. This is a moderate upfront cash amount with some improvement in your monthly costs. At the more common benchmark of 20% down, which is $80,000, you borrow $320,000 and get a better rate of 6.5% with no PMI required. Your estimated monthly payment drops significantly to $2,023. This level helps you avoid PMI altogether and makes your mortgage more affordable. Finally, putting down 30% or $120,000 reduces your loan amount even further to $280,000 with a lower rate of 6.4% and no PMI. This option offers the lowest monthly payment at about $1,751, but also means tying up a larger amount of cash up front. Overall, these examples show how increasing your down payment can lower your interest rate and monthly payments, as well as eliminate PMI costs. Let's talk about private mortgage insurance, or PMI. PMI is designed to protect the lender, not the borrower, in cases where the down payment on a home is less than 20%. This insurance kicks in because a smaller down payment poses more risk to the lender. Typically, PMI is required until you build up 20% equity in your home. Once you reach that milestone, you can usually cancel the insurance. However, until then, PMI adds to your monthly housing costs. This means that opting for a lower down payment now could result in higher overall monthly payments because of the added PMI costs. It's important to factor this into your budget when deciding how much to put down up front. Understanding PMI will help you make a more informed decision about your mortgage finances. Closing costs and fees typically range from about 2 to 5% of the loan amount. These costs include lender fees and underwriting expenses, which cover the processing and approval of your loan. You'll also encounter charges for appraisal, credit reports, and title services, all essential to verifying the property's value and ensuring there are no legal issues. Additionally, prepaid items such as taxes, insurance, and interest are part of the upfront payments. Another key component is the initial escrow funding, which sets aside money at closing to cover future property taxes and insurance. Understanding these costs helps you prepare financially for the home buying process. Here we compare two common fixed-rate loan terms, 15 years versus 30 years. With a 15-year loan, your monthly payment is higher, about $2,530, but you'll pay off the loan in half the time. This means less total interest paid, roughly $155,000, allowing you to build equity faster and save significantly on interest costs. On the other hand, a 30-year loan offers more cash flow flexibility with a lower monthly payment around $1,685. While this extends your payoff timeline to 30 years, the total interest paid is much higher, approximately $307,000. Essentially, you benefit from lower monthly payments, but end up paying substantially more in interest over the life of the loan. Deciding between these options depends on your financial goals, whether you prioritize faster payoff and interest savings, or prefer lower monthly payments to manage cash flow more comfortably. As you make payments on your mortgage, the equity you hold in your home typically increases. Equity represents the portion of the home that you actually own, and it grows as you pay down the principal balance of your loan. At the start of your loan term, your equity percentage is very low because most of your payments are going towards interest. However, as time goes on, more of each payment is applied to the principal, which means your ownership stake in a home increases steadily. This process starts off slowly in the early years, but gains momentum over time. By the halfway point of your loan term, you'll see a noticeable increase in equity growth. Eventually, at the end of the loan term, which should be around 30 years for a typical fixed-rate mortgage, your loan balance reaches zero. At this point, you have 100% equity in your home, meaning you own it outright. This gradual shift, from paying mostly interest to paying mostly principal, is what turns your monthly payments into full ownership over time. It's a powerful way to build wealth by investing in your home. Owning a home comes with several important tax benefits. First, there's the mortgage interest deduction. This allows you to deduct the interest paid on your qualifying home loan, provided you itemize your deductions and stay within the IRS limits. This can result in significant savings, especially in the early years of your mortgage when interest payments are higher. Next, we have the property tax deduction. State and local property taxes you pay on your home can reduce your taxable income, but keep in mind this is subject to the current SALT or state and local tax deduction cap. Finally, the capital gains exclusion is a big advantage when you decide to sell your primary residence. If you meet the ownership and use requirements, you may exclude a substantial portion of your profit from taxation, which can really boost your overall financial outcome from selling your home. These tax benefits make homeownership not only a place to live, but a smart financial decision. Let's talk about the different types of refinancing options available. First, we have rate and term refinancing, which involves replacing your existing loan to secure a lower interest rate or to adjust your payoff timeline. This can help reduce your monthly payments or help you pay off your loan faster. Next is cash out refinancing. This option allows you to tap into the built-up equity in your home to access funds for renovations, paying off debt, or covering major expenses. It's a great way to leverage your home's value for important financial needs. Then there's a shorter-term option, where you refinance from a 30-year loan to a 15-year loan. This usually means higher monthly payments, but significantly reduces the total interest paid over the life of the loan and helps you build equity more quickly. Lastly, we have the stability reset option. This is when you refinance into a fixed-rate mortgage to lock in predictable monthly payments, especially beneficial when interest rates are favorable. It can provide peace of mind by eliminating the uncertainty of fluctuating rates. Each of these refinancing options serves different financial goals and situations, so it's important to evaluate which one aligns best with your needs. Here we have a sample calculation to help understand when refinancing makes sense financially. The upfront refinancing cost is $4,800, and the monthly savings achieved through refinancing is $160. To determine the break-even point, we divide the total cost by the monthly savings, which gives us 30 months. This means that if you plan to stay in your home for more than 30 months, refinancing will pay off and result in net savings over time. Until that 30-month mark, you're still recovering the initial cost, so the savings haven't fully kicked in yet. Essentially, refinancing becomes beneficial only after you've crossed this break-even period, so it's important to consider how long you intend to stay in your home before making the decision. Here we're looking at 3 different loan scenarios for the same $400,000 home purchase, illustrating how varying down payments, loan terms, and interest rates affect your monthly payments and overall costs. In Scenario A, with just 10% down, the loan amount is $360,000 at a 6.75% interest rate. Your monthly principal and interest payment comes to $2,334. However, this lower upfront cash means higher total interest payments over time, about $480,240 in this case, plus closing costs and cash to close totaling $48,200. Scenario B shows a 20% down payment, reducing the loan to $320,000 with a slightly better rate of 6.5%. This brings monthly payments down to $2,023 and total interest paid over the life of the loan to $408,280. Closing costs remain similar, but the cash needed up front almost doubles to $88,000. Finally, Scenario C also has a 20% down payment, but shortens the loan term to 15 years and lowers the rate further to 5.9%. This leads to higher monthly payments of $2,684, but the total interest cost drops significantly to $163,120, saving you a lot of money in the long run. The cash to close is about the same as Scenario B. The main takeaway is that putting less money down may be easier up front, but typically results in higher monthly payments and much more paid in interest over time. Conversely, higher down payments and shorter loan terms reduce your total interest costs but require more cash up front and potentially higher monthly payments. Consider your budget and long-term financial goals when choosing which option works best for you. Here are some common borrower mistakes to avoid during the home buying process. First, don't skip pre-approval. It's important to know your price range before you start shopping. Without this, you risk wasting time on homes that aren't within your budget and making weak offers. Second, avoid changing jobs mid-process. Changing employment can delay the underwriting process or even force your lender to reassess your approval, which could set you back. Third, don't open new debt. Taking on new credit cards or car loans increases your debt-to-income ratio and may hurt your chances of qualifying. Fourth, don't ignore the total costs. Beyond the interest rate, you need to consider taxes, insurance, private mortgage insurance, and closing costs, as these all impact your monthly payment. Lastly, don't miss the rate lock window. If rates go up before you lock in your rate, your monthly payment could increase unexpectedly. Keeping these tips in mind will help smooth your path to homeownership. When shopping for a mortgage, it's crucial to look beyond just the headline interest rate. First, review the APR or annual percentage rate, which includes fees and gives you a clearer picture of the true cost of borrowing. Next, check points and fees, including lender credits, discount points, and closing charges, so you're comparing everything side by side. Don't forget to confirm the rate lock terms. Make sure you understand how long the rate is locked in and what happens if closing gets delayed. Also, take a close look at the monthly payment breakdown, which includes principal, interest, taxes, insurance, and any mortgage insurance. Finally, always evaluate offers from multiple lenders, because even small differences in terms can have a big impact on the total cost over time. The goal is to compare the full loan offer comprehensively, not just the initial rate. The Federal Reserve plays an important role in influencing mortgage rates, but it does so indirectly. Here's how it works. First, the Fed makes a decision to either raise or cut its benchmark short-term interest rate. This action then influences market rates, causing Treasury yields and mortgage-backed security yields to adjust accordingly. Following this, lenders respond by repricing fixed mortgage offers for new borrowers based on those changes. The key point to understand is that the Fed's moves don't directly set 30-year fixed mortgage rates. Instead, they shape the overall market conditions that lenders rely on to determine those rates. In essence, when the Fed changes short-term rates, bond markets react first, and mortgage pricing typically follows that reaction. Let's take a closer look at the key economic factors that influence mortgage rates. First, inflation plays a major role. When inflation rises, it typically pushes interest rates higher as lenders seek to maintain their returns. Next, employment data is crucial. Strong jobs numbers signal a robust economy, which can keep borrowing costs elevated. Then we have bond yields, especially Treasury yields, which mortgage rates tend to follow closely. If Treasury yields go up, mortgage rates often rise as well. Additionally, demand for loans matters. A surge in loan demand can create upward pressure on rates as lenders adjust to increase borrowing activity. Understanding these factors will help us see how the broader economy affects what borrowers ultimately pay for mortgages. When getting pre-approved for a mortgage, there are several key steps you can expect. First, you will complete a detailed application that includes your personal and financial information. Next, the lender will review your credit and income to assess your ability to repay the loan. They'll also verify your debts and assets, ensuring a full picture of your financial situation. Once this process is complete, you'll receive a pre-approval letter, which shows sellers you're a serious buyer. To make this process smooth, it's important to bring certain documents with you. These include recent pay stubs and W-2 forms to verify your income, bank statements showing your financial reserves, tax returns for a more comprehensive financial picture, and proof of identification along with your current employment details. Finally, it's crucial to know your budget before you start shopping for a home, so you can focus on properties within your financial means. This preparation helps you approach the home buying process with confidence. Let's review the key takeaways about fixed-rate mortgages. First, your interest rate stays the same for the entire life of the loan, which means your monthly principal and interest payments won't change. This predictability makes it much easier to budget and helps avoid any unexpected payment increases, often referred to as payment shock. However, keep in mind that factors like the loan term, your credit profile, and the size of your down payment all play a role in determining your final rate and loan pricing. It's crucial to compare different offers and consider the total cost, not just the interest rate itself. For buyers who prioritize stability and consistent payments, Fixed rate loans are generally the safest and most reliable choice. As we wrap up, remember that being ready to buy smart is key. Having a clear plan makes navigating the fixed rate mortgage process much more predictable and far less stressful. To move forward confidently, start by checking your credit and understanding your budget. Next, gather all the necessary documents for pre approval. Finally, shop around to lenders and lock in the best rate you can find. Taking these steps will put you firmly on the path to homeownership,